So we saw some problems there with deflation, and what you're going to see now is how quickly we can get into one of these really crisis deflation scenarios. In the US, we did have deflation back during the Great Depression. We had really bad deflation. Part of the reason for that is we didn't have the Fed. We had the Fed, but they didn't have a lot of power. So they were unable to do much to try to fight that. And we had a teeny bit of deflation back in, I think, 2009, but it really wasn't that problematic. But what you can see is it's kind of like once you reach a tipping point with deflation, things can get out of control very, very quickly. So let's just think about a scenario where prices drop. All right, that's just the starting point here. All right, prices drop. And let's think about what that would create in the society. And we're going to be making reference to those three things we just went through just prior to this in our video. So one thing that happens when prices drop is consumption goes down. All right, just like it does for my example of a TV. When prices drop, people want to wait to make purchases, so consumption goes down. All right, now let's do a little bit of quick supply and demand analysis. When people don't want to buy goods, so there's an equilibrium. It doesn't matter what this market is. Maybe it's housing. When people don't want to buy goods, what that does is it reduces demand and thus reduces prices. All right. So here's the weird problem that we have here, and you're going to see this over and over again. When prices drop, that causes prices to drop. Okay. When prices drop, consumers want to wait to make purchases, so demand and consumption decreases. Businesses reduce prices, because that's what they do when demand goes down. And so again, what you see here is when prices drop, prices drop. That's what makes this a deflation spiral in a sense. Once you start going down the rabbit hole, you're going to continue, all right? Once prices drop a little bit, they're going to tend to continue dropping because of this unfortunate feedback loop that we have, all right? And this is just one element of that, all right? When prices drop, people reduce spending, businesses reduce their prices, so prices drop. Second scenario, when prices drop, people hoard money. All right? Now, hoarding money, again, doesn't just mean that they're buying less. It means that they're not saving their money in banks, or they're not necessarily putting it in stocks, right? Right now, if I want to keep my money safe and earn a little bit of return, maybe I'll buy a bond, maybe I'll buy a CD. Those are great for society, because if I buy a CD from the bank lends that money out and it facilitates economic action, all right? Also, when I put my money in the bank, you get the money multiplier effect. Not when you keep it at your house, though, okay? So here's the thing. When people hoard their money, money can't multiply. All right? So I see that we have deflation. So I go to the bank, I withdraw my money. I'm not only withdrawing my money, but also it's disabling all those additional loans that would have happened from that money, right? As we've said before, if the required reserve rate is 10%, every dollar you put into a bank could generate 10 total dollars in money. So what this does is it causes the money supply to go down. Now, what happens to prices? What happens to inflation when the money supply goes down? If there's less money, money gains value, and that pushes prices down. All right? Same effect. Different avenue, but the same effect here, right? When prices drop, you get these things occurring which cause prices to continue to drop. A third scenario, all right? A third thing that happens, as we've said before, banks struggle for profits. When you have deflation, it's very hard for banks to make profits, because when you make a deposit into a bank and then withdraw that money, the money you're withdrawing is worth more than your deposit. And that's unfortunate because banks have no way to change that incentive. They can't offer negative interest rates for the most part, because people will just hoard the money if they do, all right? So if banks struggle to make profits, that means that banks will close down. And if banks close, the money multiplier goes down, right? If there's money that's not finding its way into a bank simply because banks don't exist, then the money multiplier can't happen. With no money multiplier, the money supply goes down and prices go down. All right? And then a fourth and final one, we can almost add this one to any list like this, but expectations. When prices drop, expectations are that prices will continue to drop. Because people know about these other scenarios, okay? So even if these three things don't happen, right? Even if these things don't happen, the fact that people expect it to happen will also cause prices to drop, okay? All right, so if I think these things are going to happen, and maybe I'm running a business, I might make moves that lead to lower prices for my business, okay? One thing I might do is reduce production. Think about what that does. Think about the law of supply. If I know we have deflation, well, then I'm expecting the economy to get worse, so I reduce my quantity produced. And when businesses reduce their quantity, that also leads to lower prices. So if people expect prices to drop, prices will drop. It's an inconvenient result, right? Once you start going one direction, you tend to keep going that way. Inflation really has an inertia, okay? And it's not just deflation. We saw it also with inflation, right? Hyperinflation. If prices are going up very, very quickly, that is going to tend to continue because if prices are going up, you want to spend your money as fast as possible. And as people try to spend their money as fast as possible, that drives up prices. So anytime prices get out of whack any bit, right? A little too high or a little too low, they're going to extremely move in that direction in the future if we don't have very strong monetary control, like we have in the United States with the Federal Reserve, who does a really good job of this. We don't give them enough credit, right? It's not something we think about in our lives. But what this hopefully is starting to show you is what an incredibly challenging job the Fed has. And they absolutely make mistakes, but overall, it does make the economy function a lot smoother than it would without it, at least in my opinion, okay? So, if we're thinking about what the goal is, obviously we don't want hyperinflation. All right, that's out. We definitely don't want hyperinflation. Prices going up, catastrophe. That's really the worst case scenario. Deflation, also bad. Now, deflation can be recovered, right? You can fix deflation a lot of times by pumping money into the economy. So if you have a good monetary system, you can fix it. This can't be fixed. This has never been fixed in the history of mankind. We've had many examples of hyperinflation. It never resolves, okay? Because basically what hyperinflation is people saying, I don't trust the currency anymore. You're not going to recover from that, okay? Deflation is people saying, this currency is fantastic. You can fix that by just getting more currency into the economy. All right, so deflation is bad, okay? So what do we want? What you want is low inflation, okay? And it appears that the Fed has a target of about 2%. Now, how did they arrive at that rate of 2%? I don't know entirely. I don't know if 2% is better than 4% or 1%. Hell, 6, 8, 10%, maybe those are all fine too. But what this 2% does is obviously it avoids hyperinflation. We don't want that, so 2% is way lower than what we would normally think of as hyperinflation. And then also, it gives us a little bit of inflation, so we have a buffer for deflation, okay? 1% inflation is totally fine. 0.1% inflation is fine. 0% inflation is fine, okay? You just don't want to go negative. So by having it at 2%, that means that it can safely drop a bit before you have to worry about deflation. If you set this thing at 0.5%, it would only need to fall a little more than 0.5% to have deflation. So it gives us a nice little sweet spot there, okay? It also creates a little bit of incentive to spend. When prices are going up over time, that means that you don't want to wait to make purchases. You want to spend it soon, but you're also not really in a rush because you know it's not a huge distortion, okay? Also for banks, it helps them make a profit. If they're giving 0% interest, That means, with 0% interest on a checking account, the bank is paying back money that's losing value over time, just a little bit, which helps the bank make profits, actually. All right? So that's kind of what the Fed is looking for. But it's not just the level of inflation that matters. It's also the stability of inflation that matters. So now let's talk about stability. Stability itself is a public good. People prefer things to be stable, and there's very clear documentation of this. At least in terms of economic events, we want stability, okay? Most people are risk averse. A term I'm sure you've seen before, and we can define this in many different ways, but basically what this means is people don't want risk. People prefer sure things over risky things. And this is not always true, okay? People will choose to go to the casino and bet money, right? People, I think, like watching sports because a lot of that's unanticipated. People like the weather changing over time. But it turns out that when we're dealing with large sums of money and economic prospects, people are very risk averse, all right? So what that means is, imagine this gamble here. If I offered you this gamble right now, where I'm going to flip a coin, if it's heads, you win $10,000, and if it's tails, you lose $10,000, I'm guessing you would really not take that bet, right? Even though the expected outcome is $0, right? This game has no advantage to me or you. You would probably not do this. Furthermore, if I drop this thing down to 8,000, right? So for you, you win 10,000 if I flip a coin and it's heads. You lose 8,000 if it's tails. I still bet most of you would not take this, right? That indicates your risk aversion, all right? You prefer not to take risks, even when in cases where risk would actually make your outcome stronger. So we have to be compensated for risk, all right? So let's turn that back now to think about inflation. Let's say right now that inflation is 2%, right at the target that the Fed is probably shooting for right now in the U.S. economy. And I enter a 30-year mortgage. All right, I'm assuming you guys all know what a mortgage is. That's when you borrow money to buy a house. 30 years is the common length for the mortgage. It's the longest and the most common length for a mortgage, okay? Let's think about the incentives that I face and kind of how I view inflation. All right, from my perspective, the consumer's perspective, if inflation goes up, do you think that'd be good or bad for me as the borrower? Okay, so I've already locked in my locked in my mortgage. So like I said before, I just bought a house. So this is true for me. 30-year mortgage, I bought a house exactly like I am suggesting here. So from the perspective of this deal alone, if inflation goes up, is that good or bad for me? That's good, all right? That's good for me. Because what that means is the payments I'll make in the future will have a lower real cost. That term real just means inflation adjusted. So if I'm paying $1,500 a month in mortgage payments and we have inflation, high inflation, the $1,500 I'm paying in the future will be worth less. And if we're talking about a 30-year period, there can be a really big difference, right? If we have inflation of 4% instead of 2%, that ends up being massive in the long run because of the way interest compounds over time. So it'd be really good for me if inflation went up, and really bad for me if inflation went down. All right? On the other hand, from the bank's perspective, it's the opposite. Inflation going up would be very bad for the bank. All right? Inflation going up means the real value of mortgage payments will go down. Good for me, bad for the bank. And on the other hand, if inflation goes down, that's good for the bank. That means the real value of the payments that you're making as a consumer are worth more. All right? Now, why does this matter? Okay? Well, inflation, it doesn't just matter if inflation's low, high, or negative. It also matters how it's changing over time. So what we might think of is a scenario where inflation is 2% forever. And compare that to a scenario where inflation is jumping around quite a bit. It's 1%, then it's 5%, it's 2%, then it's 10%, then it's 0%, okay? In these two scenarios, thinking about the fact that people are risk averse, inflation is risky, all right? I'm risk averse, and inflation is risky. If I'm thinking about getting a mortgage in scenario 2, I might not get one, okay? Because with a 30-year mortgage, that's so many years for inflation to affect me that as a risk-averse person, I look at the inflation rates jumping around and I say, you know what? It's not worth it to me, right? If I knew inflation was going to stay the same over time, I'd be happy to do this deal. But since they're jumping around, I'm not sure if it's a good deal or not, okay? On the other hand, in scenario 1, there's no inflation risk anymore. So I'm much more likely to take that deal. And it turns out this bodes true for both me and the bank. You see, nobody likes risk. The bank doesn't like risk, and the consumer doesn't like risk. So in both scenarios, for the bank and the consumer, we would prefer to know that inflation is staying the same over time. So constant inflation is a public good. If inflation can stay roughly the same level, it turns out that people prefer that because people tend to be risk averse. All right? Just to give you another example, let's say that I sell you my car, all right? And we're not going to lock in our deal on that car until a month from now. So today you agree to buy my car for $10,000 1 month from now. If inflation jumps around a lot, that could change how much that price is in the future. And the further we push it back, 1 month, 3 months, a year, the further you push it back, the bigger problem it can be. Now, as a normal consumer, that's not something you're going to run into very often. But think about big businesses. Think about Apple and Amazon. A lot of times they're agreeing to these very long-term deals. Like, if you give us a tax break in 5 years, we'll start building a plant in 3 years. Those prices are so far into the future that inflation has a lot of time to erode the potential value of those deals. So if inflation is jumping around a lot, people will reduce their willingness to make deals. Okay? So as inflation becomes volatile, I'm running out of space here, so this is going to be kind of a weird place to put it, but if inflation is volatile, that will reduce people's willingness to make deals, especially long-term deals. And long-term deals end up being really important, like mortgages, right? Student loans. These are big deals, business loans. So if inflation is volatile, that reduces economic growth. And it reduces economic growth particularly on things that are long-term investments. So it robs wealth from future generations that don't benefit from the investment being put in. So this is a really big potential problem. So for the Fed, it's not just about keeping inflation rates low. It's about trying to keep them as stable as possible, right? Low inflation is good because it avoids hyperinflation and deflation. And stable inflation is good because people are risk averse, right? They want things to be as constant as possible. Okay, so we've got inflation risk. I didn't formally define it, but inflation risk is the inherent risk associated with changing inflation rates. And again, it's not just about the fact that inflation is changing. It's the fact that it's unknown that inflation is going to change or not. If you could predict it in the future, that'd be fine. But the problem is there's a certain amount of unpredictableness for inflation, which is going to make it difficult for businesses in particular to make choices, okay? So inflation risk is a real thing. It reduces the likelihood that people will make big decisions, big financial moves, okay? There's also interest rate risk. Turns out this is a pretty similar idea. This is just the inherent risk associated with changing interest rates over time, all right? Remember that interest rates are determined pretty much by the Fed, right? The federal funds rate tends to drive the economy. So if the federal funds rate is 4%, savings accounts, checking accounts, they're going to earn less than 4%. And then when consumers want to borrow money for student loans, housing loans, auto loans, they're going to get charged more than 4%. So that federal funds rate creates that threshold in terms of what the interest rates might be. So why is there interest rate risk? Well, let's get right back to that mortgage. Another 30-year mortgage, really the same example here. So the consumer in that 30-year mortgage faces a couple of different possibilities here, okay? Interest rates could go up or interest rates could go down. It turns out this one's pretty interesting when it comes to the prospect of mortgages, all right? This is going to affect different people in different ways. So think about this. You've got a housing loan. You've already jumped into this 30-year mortgage. You're me right now. You've got an expensive house, a 30-year mortgage you just started paying, and you notice that interest rates have gone up, okay? Is that good or bad for you? This is kind of good, right? What makes this kind of a good deal for you is it doesn't change your current deal, but it means you got a relatively good deal on your mortgage. So I paid 2.875% for my current mortgage. If I find out that interest rates go up to 4%, it doesn't change my terms, but it means I got a relatively good deal. So I'll be retroactively happy with my decision, all right? On the other hand, if interest rates go down, turns out this is actually good too, potentially, right? Now, how can it be good if they both go up and down? That seems strange. Here's the thing. If you have a mortgage, you can refinance. You can basically pay another company to pay off your loan, all right? So if right now interest rates drop even further, I could get another bank to buy my loan and start charging me a lower interest rate, all right? So this can be okay for me too, potentially, all right? So in this specific case, it's all right to be a consumer. Now let's think about the bank. Two different scenarios here. If you're a bank thinking about the mortgage that I am in right now, is it good or bad if interest rates go up? It's bad, all right? Now, you'll be able to make more loans and such in the future, but you are stuck for 30 years in this mortgage. So this is real bad, all right? You basically, there's an opportunity cost to money. If they had just waited and given a mortgage in the future after interest rates had gone up, they would have generated a lot more profits. So this is bad, and there's no way really for that bank to fix that problem that they're in. They will incur a financial loss. Essentially, anytime interest rates go up, any locked-in rates that have already occurred are now they're in a losing situation for the bank. If the bank wanted to sell those mortgages off, they would lose money on those deals, okay? If interest rates go down, well, that's good, all right? So from the consumer standpoint, this is part of what makes mortgages a good deal for consumers in a lot of cases. It's good either way. Interest rates go down or up, that's fine. But on the bank's side of things, this can be really bad, all right? Still, it seems kind of innocuous, right? It doesn't really seem like that big of a deal. Trust me, this can be a big problem, all right? This can be a really, really, really big problem. This has actually happened before in the U.S. We may talk about this in the future. I'm being flexible with this class, but in the future we may talk about what happened in the late 70s, early 80s. It was basically this, okay? Here's a potential disastrous scenario. Let's say, to keep it relevant, let's say in 2021, a bank makes loads of 3% interest mortgages. And that's happening right now in the U.S., right? At the time of recording, it's 2021. The banks are making loads of these 3% mortgages, some even lower. I actually sold a house today. I sold a house today, and the lender was actually saying that they had financed a loan at 1.875% that day. 1.875%. It's practically free money. All right, so interest rates are incredibly low. Sounds good if you're the borrower. But the problem is they can't really go any lower than that. So I'd be scared if I was a bank because they could go up. Let's think about what happens if they go up a lot. Let's imagine in 2025, here's the interest rates we have, all right? Let's say the federal funds rate has jumped up to 10%, okay? That could happen. The federal funds rate's been close to 20% before, so it absolutely could happen, all right? And as a result, mortgages now are going for 15% on average, you know, you got the risk premium built in. Savings accounts, checking accounts, they're going in about 6%, you know, on average. And let's think about how this would affect the bank, all right? Remember, they've made a ton of these mortgages in the past. And these people aren't in any rush to pay off their mortgages, right? They've got a really good thing going on here. They've got interest rates of 3%. Hell, there's no reason to pay this off if you're the homeowner here, okay? Think about this. Rather than paying this off, which allows you to avoid 3%, you could take extra money that you could pay off the house and just put it in a savings account and get 6%. So nobody's going to be paying these mortgages off. So the bank is going to be stuck with these, okay? So think about how this affects banks, all right? So here's what this would effectively do if they're in this situation, okay? Let's think about what the bank is paying out, all right? As a borrower, right? As a borrower, the bank is going to be paying out consumers 6%, okay? 10% if they want to borrow from the Fed, all right? So if a bank wants to get money, it's got to compete with the rest of the market. The rest of the market is offering 6% on checking and savings, so the bank is going to pay 6% on money that it gets, all right? Now think about what it is earning. In reality, there's going to be a smattering of different things that the bank is receiving, but if they did a whole bunch of these mortgages back here, they're earning 3%. This is a problem, all right? Banks make money off of paying less than they charge, right? Normally what a bank would do is give saving account holders 2% and then charge mortgagors 7%. Then they profit that little 5% difference between the two, that interest rate spread. But in this scenario, it's like they're losing 3%, okay? Now, I know what you might be thinking. You might be thinking, well, why not just do more of these 15% mortgages? Where are they going to get the money, all right? They don't have any money. They did so many of these mortgages in the past that they've run out of money here. The only way to get more money is to borrow more money, all right? But who's going to loan to this bank now? This bank is in an upside-down situation where it can't profit. And all banks would simultaneously be in this scenario, okay? This happened back in the late 70s, the early 80s. If you want to look it up, it's called the savings and loan crisis. So we might talk about it in the future. So here's the problem. Banks don't know what's going to happen to interest rates in the future. And there's always that threat that interest rates could go way up. Since there's that threat, banks may decide not to make loans, right? So this happened back in the 70s and early 80s, but think about a bank today in 2021. What it might decide to do is not make these mortgages at all, reducing the number of home purchases that are happening in the United States. It doesn't have to just be mortgages, it could be business loans and such too, all right? So when interest rates are unknown in terms of how they're going to change, banks are not going to make as many choices out there in society. They're not going to make as many loans. That not only reduces economic growth, but it also might affect the money multiplier. Because if banks are holding extra money, it's not getting lended out, you don't have as much money for society, okay? So, you know, banks and the Fed, obviously they're intertwined. And so the bank have to think about all these things. They have to think about, we think about their dual mandate that they face, right? They have to think about interest rate risk. They have to think about inflation risk. Right? It's not just about is inflation high or low, it's about is it changing. It's not just about if interest rate is high or low, it's is it changing over time. And on top of that, they got to think about exchange rate risk too. We'll get more into this in the future, but essentially the money supply in the United States and inflation also affect exchange rates. So if we have high inflation, that means US dollar is usually going to lose value relative to the euro as well. that also can be a big problem. If I'm a business that's about to buy a bunch of vehicles from Japan a year from now, right? I'm ordering 1,000 vehicles from Japan a year from now. I don't know what the exchange rate is going to be a year from now. So I might not make the deal, all right? So the Fed's got to worry about exchange rates too. They got to worry about everything, all right? So they have this mandate: low unemployment, high employment, keep interest rates stable, keep inflation low and stable. And these are all public goods in the sense that these things benefit everyone, and there's no way to take away those benefits, all right? We all benefit from these things, and so we need a public entity to take care of it. We cannot have a for-profit business running this. If they fail, and they're trying to do this, imagine a private business, a private bank that was running all of this, a truly private for-profit bank, right? If they fail, well, no big deal. If I'm the CEO of a bank that's trying to keep low inflation for my economy and I fail, well, my business goes under, but I can get a job somewhere else. That's a problem, right? We need someone overseeing this. We need government or quasi-government intervention like we have in the United States, okay? Hope all that made sense, right? We need to think about inflation, interest rates, and even exchange rates if we're going to maintain a strong economy.